interesting.
Let's get into the broader discussion here and start with BlackRock, which is the world's largest investment management firm. It has $5.1 trillion under management.
That is a very large sum of money.
A large sum of money. Market cap here, $61.7 billion.
Price to earnings ratio 20.26, dividend yield 2.59. Located in downtown, or midtown actually, Manhattan in the United States of America, really a principal player in that market.
You get excited about BlackRock.
This is really the stalwart of the industry. It's grown by acquisition over the years and it's established itself as the player in the asset management industry. They've gone very big into ETFs and they bought iShares about 6-7 years ago from Barclays, quite a big transaction. And that was transformative in their process because they've gone heavily into index funds. And that's this theme we talk and this trend of going into low-cost funds. It is debatable whether an active manager can beat the market or not. And the rise in these index funds, and they've really capitalized on that. And last year they saw their biggest inflow yet into assets under management. Over $200 billion of new money last year.
Can that be attributed to the change in strategy and the further allocation to index funds?
Yes, that is their big growth area. So Vanguard, which is an unlisted, it's a co-op kind of business in America.
That's Jack Bogle.
Yes, is the other big hefty player in the space, and both of them saw tremendous growth last year.
Paul, something to think about, these index funds?
Absolutely. Look, I think in 2015, if you looked at BlackRock's assets under management, 65% of them were from institutional sources. And what that means, it's pension funds for big companies and other large funds and trusts and so on. And what they're looking for is those index funds, and that's fine. So what BlackRock does is it makes provision for those products. Then it also has other things going on. It's always had a strong focus on risk management. Its founder, Larry Fink, really came to the market with that approach. Remember, a big push for them was in 2008 when the US government identified them as a new untainted player and turned over the management of quite a number of portfolios of bonds and other things that the US Treasury picked up in the crisis. And the Fed and themselves then worked together to manage their way out of these portfolios.
Let's get a look at the share price graph here, and that'll give you some
It's gone with the market, and in recent times you can see it's also picked up because remember, whatever you say, the value, even if you have no juiced up performance fees in your mix, just by virtue of the funds doing well. They went from $4.5 to $5.1 trillion worth of assets under management just because the market went up. Then you're going to make more money.
You wish, both of you.
To have that kind of assets under management, Larry Fink must be nice.
So now let's go to the question that you asked at the outset, Paul, and that is great performance in terms of share price, but is it a good investment?
I think it is a good investment. This is, can it sustain its growth? And these businesses, if they are well managed, which this one is, they focus very much on their costs, their returns, their risk management. It really is the full package. They've got quite a wide spread of asset choices that you can go for. And it makes money on money. That's the kind of business is what we're saying. Because assets under management go up, because share prices go up, and so you see the circle continuing. So they are good businesses. Whether it's fairly priced is a different story. They're very cash generative, and you see quite a nice dividend yield in hard currency coming out of BlackRock. So yes, they are good businesses, and this one in particular, I think it is a very good business.
Paul, do you concur with Lance's view?
I would say so, yes, and I like the fact that they have this strong focus on the iShares business as well, so I think they are protected. I think there are other smaller US-based investment managers that have a higher active management component to their earnings, which would be more at risk with the industry shifts we're seeing. So
hot
for me.
Or not, Lance?
Hot on this one.
You're hot, Paul. You jumped the gun there. You're hot as well.